Okay, Ji. Now the topic that we shall be discussing today is the bond yield and bond valuation. Now let's just talk about this concept of bond yield and bond valuation, that what exactly is bond yield, bond valuation. Now, you see, when we talk about the various sources of finance, so we do know that we have got various sources of finance, which includes majorly the debt instruments and which includes the equity instruments. Now, when we actually talk about the debt instruments as a source of finance, so the one thing that is actually important is you can understand that when we go for debt as a source of finance, we can either go for the bank loan or we can actually go for issuing of the debentures. And there are also other forms of obtaining the debt finance, but these are principally the two major modes, which is either you obtain a bank loan or you issue a debenture. Now, so basically when we issue a debenture, so there are certain factors that need to be considered. Now, what are those factors that actually need to be considered? So one of the more important factors is basically what should actually be the coupon rate. One of the more important factors is to establish that what should be the coupon rate. That's the number one factor. The second factor that actually needs to be established is that what should be the issuance price. What should be the issuance price? So one of the factors is what should be the coupon rate. The other one of them is what should be the issuance price. That is, should we issue the bond with a 10% coupon rate? Should we issue the bond with a 12% coupon rate? Or what should be the coupon rate? Should we issue the bond at par value? Should we issue the bond at premium? Should we issue the bond at discount? What should be the issuance price? So basically, when you issue a bond, these are majorly two factors that you need to consider. One of them is what should be the coupon rate. The other one of them is what should be the issuance price. So the concept that we shall be discussing in this specific article is going to be the bond valuation, which is basically how do we value the bonds. Number one. The second one of them is what should be the bond yield. Yield actually means the return. So what should be the bond yield? Yield actually means the return. Now, before I move further, what I'm actually going to do is that I'm going to discuss few concepts. And once we have actually done discussing those concepts, then we'll move forward. Now, first of all, you need to understand one thing, which is basically what exactly is a bond value? What exactly is a bond value? Now, so whenever we talk about the bond value, so the method of valuing a bond is basically the cash flow based valuation method. Method of valuing the bond is a cash flow based valuation method. That is, value of a bond is the present value of future cash flow. Value of a bond is the present value of future cash flow discounted using market rate of interest. Discounted using market rate of interest. So value of a bond is the present value of future cash flow discounted using market rate of interest. For example, you have got a bond which is 10%, $100 3-year bond. You've got a bond which is 10-year, $100 3-year bond. Now let's just take an example. This is example number one. So the first example is that the market rate is 10%. Now, if the market rate is 10%, how would we establish the value of this bond? Let's just discuss. You would say here. You would say cash flow, you would say discount factor, and then you would say present value. So from year 1 till year 3, there is actually going to be interest. How much is going to be the interest? The interest is going to be 10% into $100. So this actually gives you $10. And in the year 3, if we are not being told anything, we generally assume that the redemption is going to be at par. If we are not being told anything, we assume that the redemption is going to be at par. So we are going to say $100 over here. If I use 10%, which is the market rate or the discount rate, then what is actually going to happen is this is going to be 2.48 or 2.49. So, okay, so that's what you get. What do you get? You get the present value of the future cash flows to be $100. So what have we established over here? What have we established over here? That if the coupon rate is equivalent to the market rate, if the coupon rate is equivalent to the market rate, then what actually happens is the par value of the bond equals the market value. So if the bond has a coupon rate which is equal to the market rate, that means the par value of the bond and the market value of the bond would be the same. Okay, let's move forward. Let's take another example. And now the second example is that the market rate is 12%. Now the second example is that the market rate is 12%. Now what could be the market value of the bond? So then again say here, we would say cash flow, we would say discount factor, and we would say the present value. Now when we would actually talk about it, you would say year 1 till year 3, there is actually going to be a $10. Then year 3, you've got $100. The discount factor is actually 12%. The discount factor is actually 12%. So if we use 12% as a discount factor, what is the total present value of the cash flows? Okay, so we have been able to establish the value of the bond to be 95.1 over here. So what have we got? We have got 95.1 as the value of the bond. Previously, we got the value of the bond to be $100. Now, the concept that I'm actually trying to establish is basically you need to have a connection between the coupon rate and the market rate and the market value of the bond. Now, what is that connection? That connection is basically there is a bond which is offering 10% coupon. There is a bond which is offering 10% coupon. Now, the market rate is basically 10%. So that means the investor, and I'm assuming that the standard par value is $100. I'm assuming that the standard par value is $100. So now, if there is a bond which is offering 10% coupon on a $100 par value, and if you want to invest $100 in the market, you can only invest $100 at the 10% rate. So that means the market value of this bond is also going to be 100, because there is no difference between this bond and what is available in the market. Because if I go into the market and if I invest into the market, if I have to invest $100, I'm only getting 10% return. Now the next thing, the bond is giving me 10% coupon. And in market, if I invest $100, I get 12% out of it. So that means I'm getting more return in the market as compared to the return that is available on this bond. So if I'm actually going to buy this bond, I'm not going to buy it at a par value. I'm going to buy it at a discounted price. And that has been evident over here, which is 95.10. Why? Because the reason behind that is I'm getting lower return on this specific bond. Similarly, if we come across a third situation where you've got a market rate, which is, let's say, 8%. So if the market rate is 8% and this bond is giving you 10% return, if the market rate is 8% and this bond is giving you 10% return, that means this bond is more valuable. Now, if this bond is more valuable, that means what would happen is this bond would be worth more than $100. This bond would be worth more than $100. Why? Because the market, you can only in the market you can only get 8% by investing $100. So if there is a bond which is available on which you are getting 10%, that means this is a return greater than the market return. So the overall value of this bond is going to be greater than the market value. Okay, is that fine? Now, so we established few things, which is number one, we've established the linkage between the coupon rate, the market rate, and the market value of the bond. Now let's move forward. Let's talk about the concept of bond yield. Now, what exactly is the concept of bond yield? So when we talk about the yield actually means return. When we talk about yield actually means return. So when we talk about the concept of bond yield, so the bond yield actually refers to the return that an investor gets by investing in a bond. So the return that the investor will get by investing in a bond, that is going to be considered as the bond yield. Now, let's just try to understand one more concept, which is basically, we saw this thing that if the bond is 10% coupon and the market rate is 12%, then the value of this bond is 95.1. Now, what does this value of 95.1 indicate? This value of 95.1 indicates that the investor will only be willing to pay $95.1 for this bond. This value of 95.1 tells you that the investor is only willing to pay $95.1. Is that fine? Okay, now let's see. So if the investor is only willing to pay $95.1, now, so that means, why is the investor only willing to pay $95.1? Because the investor would want to invest that much such that his return becomes equal to the market rate of it. Now how? Let's see. I'm going to take the same figures which were there. So they basically, let's say that investor purchases a 10% $100 3-year bond for $95.10 for $95.10. So let's assume that there is an investor who purchases a 10% $100 3-year bond for $95.10. Now let's see. So if I have to establish the bond yield, if I have to establish the return that this investor has got by investing in this bond, so the way to establish the return is to calculate the IRR. Now, so what we are going to do is that we're going to calculate the IRR for this specific investor, and we would see that what exactly is the total yield that he has got. Here cash flow, discount factor, then depreciation. Now let's see. So if you think from this investor, he has invested 95.1 at year 0. He is getting year 1 till year 3, he is getting $10, and year 3 he will get $100. Now what we need to do is that we need to establish the IRR. So the first discount rate that I'm actually going to take is, I'm going to take 10% as the first discount rate. So it's going to be 1, it's going to be 2.49, it's going to be 0.751. So it's going to be 75.1, 24.9, and this is 95.1. So resultingly, you will end up getting how much? $4.9. Okay, so let's take the other discount factor as 15%. So if we take 15% as the other discount factor, so how much is it going to be? And then you've got 0.65. So we end up getting negative 8.1. Now, if I need to calculate IRR from this information, I'm going to say I've got 10% plus 4.9 divided by 4.9 plus 8.1 multiplied by 15% minus 10%. So how much does it turn out to be? So it's up almost 11.88 or 11.9%. Now, there is obviously a rounding of error. There's obviously a rounding of error which is actually preventing us from achieving a value of 12%, but it's almost 12%. It's almost 12%. Now, so basically, what I'm actually going to do is that I'm going to summarize what I have discussed up till now. I'm going to summarize what I have discussed up till now. So what have we discussed? We have actually discussed these things. That what exactly is the bond value? So the bond value is present value of future cash flows discounted using the market rate of interest. And similarly, what exactly is the concept of bond yield? Bond yield is actually a return that the investor gets while investing in a bond. So now see, if the bond had a coupon rate of 10% and there was a market rate of 12%, so why was the investor willing to pay only $95.1? Because if he pays $95.1, then the yield becomes 12%, which is equal to market rate. I'm repeating it again. If I'm an investor, I would never want to lose my money. If I'm an investor, I would never want to lose my money. I know that I can get 10% from the market. I know that I can get 12% from the market. Then why would I invest in a 10% bond? I would only invest in a 10% bond if I can get it at a discounted price. Okay, how much discounted price do you want to buy it at? I want to buy it at a discounted price at which my overall return would equal the market rate of it. So basically, you see, first of all, what did we do? We just calculated from the perspective of an issuer, that if the issuer is issuing a bond with a 10% coupon, where the market rate is 12%, so we established that the value of that bond is going to be 95.1. Now, who is willing to pay 95.1? Investor. Why? Because at 95.1, the investor knows that even if he gets a 10% coupon, his overall return is going to be 12%. How did we establish that? We established that using this IR. Just try to establish the connection between this whole calculation. If you establish a good connection between this whole calculation, you would find things to be quite easy in the whole P4, because this bond yield, bond valuation concept is applicable at a lot of locations, at a lot of places. You would come across this concept at a lot of places in this whole P4. So please go through it. Please try to absorb this. Okay, so we have actually gone through this basic concept of bond yield and bond valuation. Now, what are we going to do? We're going to develop from here, and we're going to discuss further that what exactly are the other aspects that are discussed in this specific article. So the first of all, one of the concepts that was discussed in this article was basically that how do we establish a bond value or a bond price. So we do know that how to establish the bond value or the bond price. It's simply present value of future cash flow. It's present value of future cash flow and discounted using market rate. Discounted using market rate. Now, the next situation that we have actually discussed is the concept of bond yield. Now, let's just try to discuss this concept of bond yield. So we did discuss that the bond yield refers to the return that the investor gets when he invests in this bond. The bond yield is also termed as yield to maturity or the gross redemption yield. So what is this yield to maturity gross redemption yield? It's simply bond yield, which is the concept that if an investor holds this bond till maturity date, if the investor holds this bond till maturity date, then the overall return that he will generate is called the bond yield or the yield to maturity. If he holds this bond till maturity, the overall return that he will get is called yield to maturity. Now, how do we calculate the yield to maturity? So we have discussed that the yield to maturity is calculated using IR. Now, let's move forward and let's just discuss the third concept, which is basically now another concept which is called the term structure of the interest rates and the yield curve. Now, what exactly is this term structure of the interest rate and the yield curve? So let's actually have a discussion about the yield curve, that what exactly do you mean by yield curve and what are the various shapes of the yield curve. So let's have some of the discussion about the yield curve. Now, okay, what exactly do you mean by yield curve? So let's assume if you go to a bank and you ask the bank that I want to borrow for 1 year, what is going to be the interest rate? The bank tells you 5%. For example, you go to a bank and you say that I want to borrow for 2 years. The bank would say that the interest rate applicable would be 7%. For example, if you go for 3 years, the bank might say 8.5%. For example, if you go for a 4-year loan, the bank might say 10%. Now, what exactly do you mean by yield curve? Let's say if I plot these rates onto a graph, let's say if I plot these rates onto the graph, I would say year 1, I would say year 2, I would say year 3, I would say year 4. So it's 5%, it's 7%, it's 8.5%, it's 10%. So if you actually see this curve, it's actually like this. So what exactly is the concept of yield curve? So when we talk about the concept of yield curve actually means that if you actually just plot a graph for interest rates based on various maturities. If you plot a graph for interest rate based on various maturities, then the curve that you get is called yield curve. Then the curve you get is called yield curve. Plot a graph for interest rate based on various maturities. Okay, now let's move forward. Let's discuss further. So we have discussed this concept of yield curve. Now let's discuss. Now when we talk about the next concept, so what exactly is the next concept? Basically, the shape of yield curve could be of two types. A yield curve could be upward sloping. A yield curve could be downward sloping. A yield curve could be upward sloping. A yield curve could be downward sloping. Now, what exactly is the difference between this yield curve to be upward sloping and downward sloping? So when we talk about the yield curve to be upward sloping, this is how it is. When we talk about the yield curve to be downward sloping, this is how it is. Okay, so this upward sloping yield curve is considered to be a normal yield curve, and this is considered to be an abnormal yield curve. So when we say that it's a normal yield curve, that means if you analyze the yield curve at any point of time, you would generally find it to be an upward sloping yield. Now, why is a yield curve always an upward sloping yield curve? So yield curve is majority of the time it's an upward sloping yield curve because of multiple reasons. Now, what exactly are those multiple reasons? So if I talk about the multiple reasons behind those yield curves, then one of the basic reason is basically called liquidity preference theory. That is called liquidity preference theory. Okay, what exactly do you mean by liquidity preference theory? So the liquidity preference theory means that the investor prefers to stay liquid. Investor prefers to stay liquid. Now, if the investor prefers to stay liquid, then what exactly do you mean by that? If the investor prefers to stay liquid, That means if you actually obtain funds from them for a longer period, they would want more return. They would want more return to compensate to encourage them to forego liquidity. So what does this liquidity preference theory indicates? The liquidity preference theory says that the investor prefers to stay liquid. Now, when the investor prefers to stay liquid, this actually means that if you obtain the funds from an investor for a longer period of time, so the longer the duration, the investor would demand more and more return. The longer the duration, the investor would demand more and more return because he wants himself to be encouraged, he wants himself to be motivated to give away his liquidity. So he would only give away his liquidity if he gets a greater return for a longer period. So an investor would need more return in order to forego their liquidity. That was upward sloping. Well, generally speaking, if you go about with the yield curve, then what would happen is that if anyone wants to go for borrowing the funds, because you see, if somebody is borrowing, the other person is lending. So the rates that would be applicable to the borrower would be these. Similarly, the rates that the lender would demand would be like this. Generally, a yield curve is upward sloping. One of the reasons behind that is liquidity preference theory. The second reason for the yield curve to be upward sloping is the market expectations theory. Or which is more commonly known as expectations theory. Now, what is this expectations theory? It actually says that if expectations of investors is that interest rates will increase in future, they will demand greater return for longer term commitment. They would demand a greater return for longer term commitment. So what is this expectations theory? This expectations theory actually tells us that if the expectations of the investor is that the interest rate will increase in future, they will demand greater return for longer term commitment. So generally when we talk about the yield curve, we talk about the yield curve to be upward sloping, and there are probable multiple theories behind it. So few of the theories are liquidity preference theory and the expectations. Now let's move forward. So basically what happens is, you have understood the concept of term and structure of interest rates and the yield curve. So basically what happens is, the greater the term of borrowing, usually the interest rates would be higher. The greater the term of borrowing, the interest rates would be higher. Now, so basically a better way, or at times when you come across an exam scenario, you come across a situation where the examiner gives you a yield curve. Examiner gives you a yield curve. So if the examiner gives you a yield curve, what does that mean? Yield curve means that you are being given interest rates for the various periods. If the examiner gives you yield curve actually means that he is giving you interest rates of the various different periods. Now let's see. So if the examiner is giving you interest rates for the various different period, now let's see. So it says a company wants to know. So basically, if you are being given interest rates for the different periods, so the value of the bond is the present value of future cash flow discounted using relevant yield curve. Now, what do you mean by that? It says company wants to issue a bond that is redeemable in 4 years for its par value or face value of $100 and wants to pay an annual coupon of 5% on the par value. Estimate price at which it should be issued. So what does it say? It says 5%, $100, 4-year bond. You need to establish the value of this bond. And you're being given a yield curve. You're not being given a single market rate, you're being given a yield curve. So if we are being given yield curve and if we are not being given a single rate, so how would we do things? We are being given 3.5% as the first year yield curve, 4% as the second year yield curve, 4.7 third year, 5.5 fourth year yield curve. So what will we do is that the year 1 year cash flow, discount factor, and then present value. So basically what is actually going to happen is, this is going to operate like this. The things are going to operate like this. How? See, the things are going to operate like this. Year 1, we have got 5% into 100 gives us 5. The discount rate is going to be 1.035 power minus 1. We need to have the second year, which is then again 5, but the discount rate over here is going to be 1.04 power minus 2. The third situation is basically year 3, where then again 5, 1.04 power minus 3. And then year 4, it's actually going to be 105. So it's going to be 1.047. Now this is going to be 1.055 power minus 4. So this is how you are actually going to discount them. This is how you're actually going to discount. So for the year 4, we have got interest plus redemption both. Okay, is that fine? Now, so basically what have we discussed up till now? We have discussed that how to establish the value of a bond using the market rate. We have established that how to establish the value of the bond using the yield curve. And we have also established that how to establish the yield to maturity or the bond yield, that is the return that the investor would get while investing in this bond. So these are the 3 things that we have discussed. Now, there is another scenario that can probably arise where the examiner may ask you to estimate the yield curve. There could also be a scenario where the examiner can ask you to estimate the yield curve. Now, what could be that scenario? Now, let's actually talk about this specific scenario. This is example number 4. The examiner has performed working, but what I would want to do is that I would want to do the workings on my own from the start so that you can have a better understanding about it. Now, so what are we going to discuss? We're going to discuss that what if the examiner asks us that we need to establish the yield curve, we need to estimate the yield curve. So basically now we are going to discuss that how to estimate the yield curve. How to estimate yield. Now, so we have been given this example number 4 where it says a government has 3 bonds in issue that all have a face or a par value of $100. and are redeemable in 1 year, 2 years, and 3 years respectively. So there are basically bond A, there's basically bond B, there's bond C. All of the bonds have a par value of $100, $100, $100. It's redeemable in 1 year, it's redeemable in 2 years, it's redeemable in 3 years. Furthermore, it says, let's assume that all of them are government bonds. So if they are all government bonds, that means they are of the same risk class. If I say all of them are bonds of Unilever, that means they are of the same risk class. Now let's see. It says, let's also assume that the coupons are payable on annual basis, which is redeemable in a year's time, at a coupon rate of 7%. So the first bond has a coupon rate of 7%. And is trading at 103, and the market value of this bond is presently 103. And we have been given the other information. It says bond B is redeemable in 2 years' time, has a coupon rate of 6%, and is trading at $102. And then you've got bond C, which is redeemable in 3 years' time, has a coupon rate of 5%, and is trading at $98. So we have been given this information, and we are required that we need to estimate the yield curve. We are required to estimate the yield curve in this scenario. Now, what I'm actually going to do is that I'm going to recall a basic concept. You people do have an idea what is an IRR. IRR is the discount rate at which NPV is zero. We just used an example where we estimated the bond yield using IRR. We did estimate the bond yield using IRR. So I'm now discussing IRR further, and I'm saying that IRR is the discount rate at which NPV is zero. Is that fine? So we can also say IRR is the discount rate at which PV of inflow is equivalent to PV of outflow. Is that also fine? So we can say IRR is the discount rate at which present value of inflow is equivalent to present value of outflow. Now let's discuss bond one. Basically, what is actually happening with bond one is, think from the perspective of an investor. Being an investor, what would happen is, you would invest in year 0, 103, and you would get in year 1, 107. How 107? Because what is going to happen is, there is going to be a $100 redemption plus $7 interest. So think about an investor investing in bond A. An investor investing in bond A, what is he going to invest? He's going to invest 103 at year 0. What will he get? He will get 107 in. He'll get 107 in first year. Is that okay? Okay. So basically, we could actually establish the IRR of the bond for this investor by saying that 100 and 103 is equivalent to 107 into 1 plus R power minus 1. Is that okay? Because this investor would invest 103 in year 0, and he would get 107 in year 1. And if we discount this 107 at a discount rate of R, then the present value would equal to 103. So what is the discount rate of R? Okay, so let's try to establish R using this whole formula. So let's say 103 is 107 divided by 1 plus R. Then what would happen is basically you would say 1 plus R is equivalent to 107 divided by 103. So how much is this R? How much is this R? So if we say it becomes 3.88%. So it becomes 3.88%. So what have we done up till now? We've established the first year yield curve to be 3.88%. Is that fine? Okay, now let's move further. So we've established the first year yield curve. Now what do we need to do? We now need to move forward and we need to establish the other yield curve. Let's talk about the second year. Let's talk about the second year. Now, if we talk about the second year, let's just see. So the second year is going to be 102 is going to be equal to 102 is going to be equal to 6 into 1.0388 power minus 1 plus 106 into 1 plus r power minus 2. Because we do know the first year yield curve. So we are going to discount the first year interest with the first year yield curve and the second year yield curve is unknown. Okay, 3.88% is actually the first year yield curve that we have estimated. So for every subsequent calculation, we'll use 3.88% for the first year yield curve. Okay, now let's see. So basically it's going to be so it will become 102 is equivalent to 5.776 plus 106 divided by 1 plus r power 2. So resultingly we'll have 1 plus r power 2 is equivalent to 106 divided by 96.22. So you'd get 4.95% as the R. Because what you need to do is that the next step is going to be 1 plus R is equivalent to root 106 divided by 96.22 and then you'll end up getting that. Okay, is that fine? So you would apply the same concept to establish the yield curve for the year 3 also. Okay. Now, so what I'm actually going to do now is, we already have this example solved here. So this was actually 4.95 or 4.96%, but basically the writer to this article had solved it, but at times it becomes difficult for a student to understand. So that's why I decoded this whole example. So end of the day, you've got bond A 3.88%, bond B 4.96%, then you would have estimated 5.8. So this is how the yield curve is going to be estimated. Is that okay? Is that fine? Okay. Now, we now need to discuss the last concept with respect to this yield curve. And what is that last concept? Let's just actually talk about it. Now, what exactly is that last concept? Let's discuss. Basically, what happens is, there is a concept called credit rating. There is a concept called credit rating. Now, what exactly do you mean by the credit rating? So at times, there is a credit rating for a company as a whole. There is a credit rating for a bond. There is a credit rating for the specific division of the entity. There could be multiple credit ratings. The credit rating of any entity, any bond, etc. actually shows you the credit risk involved. Generally, various countries have got different credit rating agencies. But the worldwide credit rating agencies which are very famous are S&P, Standard & Poor's. Then there is this Moody's. So these are various credit rating agencies which are very famous across the globe. Now, what these credit rating agencies they do is that they evaluate a company, or they evaluate a debenture, or they evaluate a bond, and they assign a credit rating, a credit risk to that. So on the basis of the credit risk to that bond, what happens is that usually, let's say that if you come across a credit rating like this where AAA, AA, A, so that means AAA is most secured and this A is least secured. So if the examiner gives you credit rating in any given scenario, he would actually explain to you that what exactly these credit ratings generally means. So generally what happens is AAA is considered to be the highest rating, or there could actually be even AAA plus. You can have AA, you can have A, and even if the credit rating agency changes, the credit rating agency can have its own symbols for the credit rating also. So it's not necessary that you find a credit rating to be AAA, AA, BBB, etc., etc. Now, so basically what happens is, when we have to estimate a yield curve, the yield curve of any specific debenture, any specific bond, any specific company, so the best way to do is that the first thing is we need to establish the credit rating of that company and that bond. And then we need to explore the financial press to establish that what are the credit spreads prevalent. Now, what exactly do we mean by credit spreads prevalent? What do we mean by credit spreads? This is the table of credit spread. Now, what is the table of credit spread? Let's say that there is a government bond. Let's say that this bond which we have estimated the yield curve is a AAA rated bond. So the first year yield curve is 3.88, second year is 4.96 and 5.8%. Let's say there is a government bond whose yield curve is like this. And I want to estimate the yield curve of a AAA rated bond. So how would I estimate the yield curve of a AAA rated bond? I would say AAA rated bond, year 1 yield curve has a credit spread of 14 basis point. I did discuss in the yesterday's session that what exactly do we mean by basis point. A basis point actually means 1% has 100 basis points. So if there is actually 1 basis point, this 1 basis point means 0.01%. So if there are 14 basis points, that means this is 0.14%. Then the next situation is, if there is a second year where there is 25 basis point, this is 0.25%. Then there is this third year where there is 38 basis point, the credit spread is going to be 0.38%. Is that fine? So if I need to establish the yield curve for a AAA rated bond, how would I do it? I would do it this way: 3.88 plus 0.14. So that means 4.02% is going to be the first year yield curve for a AAA rated bond. So what did we use? We used the government bond as a base rate and we applied the relevant credit spreads. Similarly, the second year is going to be 4.96 plus 0.25. So this makes it 5.21%. The third year is 5.8 plus 0.38. This makes it 6.18%. So if you have to estimate the yield curve for any specific bond, then what do we need? We need the yield curve of the government bond, and we need the table for the credit spread so we can calculate. Please go through it.